All right, welcome back to class. We're going to begin with Part 3 at this point, and Part 3 of the course provides an overview of reporting requirements for retirement and Social Security income and business income and expenses. Pacific Northwest Tax School's 1040 CPE series courses called Pension and Social Security Income Reporting, as well as Sole Proprietors and Single Member LLCs, cover the topics that we're covering in this part of the class in quite a bit of detail. But today, because of the constrictions we have, we're going to kind of race through them, trying to hit some of the most key points. But if you're getting into it and you're thinking, hey, I'd like to know more about this topic, then I recommend you go and take those other courses as part of your regular continuing education component. Let's move on now to this header right here, which says taxable distributions from IRAs, pensions, and annuities. We're going to now be looking at lines 15 and 16 of the Form 1040. And the first thing we're going to talk about is tax-free distributions from IRAs for charitable purposes. This particular measure was extended through 2014. As we're sitting here today, it is expired for 2015 unless it gets extended again. But the Taxpayer Relief Act of 2012 had a provision that was extended through 2014 that allowed tax-free distributions to charity from an IRA by someone who was age 70.5 or older of up to $100,000 per taxpayer per taxable year. We're going to spend more time on the next topic, which is the IRA one rollover per year rule. This is actually a fairly recent ruling. It came out of the courts, and the IRS had to change a long-standing practice. Under current law, you do not include in income any amount distributed to you from a traditional IRA if you deposit the amount into another or the same traditional IRA within 60 days. Prior to 2015, the IRS applied this rule on an IRA by IRA basis, but the tax court has held that you cannot make a non-taxable rollover from one IRA to another if you have already made a rollover from any of your IRAs in the preceding one-year period. Beginning January 1, 2015, the IRS will follow the tax court ruling and apply the following rules to all taxpayers. You can make only one rollover from an IRA to another IRA or the same IRA in any 12-month period, regardless of the number of IRAs you own. Also, if you make a rollover of one IRA to another, then the following treatment will apply to any subsequent rollovers you make to any of your IRAs in the same 12-month period. Firstly, subsequent rollovers within the same 12-month period will be treated as taxable distributions to the extent that they exceed basis. And you may be subject to a 10% early withdrawal tax on the amount you include in gross income, and amounts you roll into another or the same IRA can be treated as excess contributions and subject to an additional 6% tax per year as long as they remain in the IRA. So in other words, let's just suppose. All right, so I've done an illustration to explain what this new rule means in a little bit more clarity. You are age 50 years old and take $10,000 from your IRA. Within 60 days, you roll all $10,000 back into that same IRA. As a result, that IRA is not treated as having been distributed. There's no tax consequence to that distribution and subsequent rollover within 60 days. A few days later, you take $15,000 from another IRA, and then within 60 days, you roll that $15,000 back into the second IRA. For that second distribution and recontribution, things are treated differently than in the first case, because this would be the second one for the year, and you're only allowed one each year. The tax consequences of that second distribution for 2015 and any later year where a similar event would occur are as follows. The second distribution will be taxable and will be subject to the additional 10% tax. Additionally, the subsequent rollover, that is, putting the $15,000 back in again, will not be treated as a rollover and will instead be treated as a contribution. Since the contribution limit for a person age 50 or older is $6,500, the excess of $15,000 over $6,500, which is $8,500, is treated as an excess contribution and will be subject to an additional 6% tax until that excess amount is withdrawn. So that's a pretty significant change in how IRS is administering the law, and it's thanks to that court ruling. Now, the rule itself, that is the rule of only one IRA rollover per year, does not affect trustee-to-trustee transfers. You can continue to make as many trustee-to-trustee transfers between IRAs as you want. You can also make as many rollovers from traditional IRAs to Roth IRAs or conversions as you want. Let's talk about determining the taxable part of your distribution next. Your distribution from your retirement plan may be partially or fully taxable, and to be partially taxable, you must have made after-tax contributions to the plan or annuity. Your after-tax contributions are your cost in the plan. Your distribution from your retirement plan will be fully taxable if either of the following is true. You made only pre-tax contributions, or your employer paid all of the cost of the contributions for you. So let's talk about cost or investment in the contract. Before you can figure out how much, if any, of your pension or annuity distribution is taxable, you must first determine your cost in the plan. Your total cost includes amounts you paid and amounts your employer paid that were taxable at the time paid. If all of your contributions were pre-tax contributions or were made on your behalf by your employer, you do not have a cost in your plan and your distributions will be fully taxable. If you made non-deductible contributions to a retirement plan or annuity, the payer may indicate the taxable part of your distribution in Box 2B of your Form 1099-R. So if Box 2B is blank, then you figure the taxable portion of your distribution by completing the simplified method worksheet. One of the rules to bear in mind is that if there is a plan administrator who is calculating the cost recovery part of distributions from pension plans, then you can pretty much rely on the amount that they're putting in Box 2A and treat that as the taxable amount. But if the trustee of the plan has checked Box B saying the taxable amount is not determined and then left Box 2A blank, it's going to be left to the taxpayer to determine how much of their distribution is taxable. And if they don't know how much is taxable and they're not able to show how they calculate a basis in their contract, then the IRS will assume it is all taxable. And in most cases, it probably is fully taxable. So if you made a non-deductible contribution to your IRA, though, you figure the taxable part of a distribution from your IRA by completing Form 8606. So let's talk about 8606 next. If you withdrew money from a traditional IRA in which you have a cost basis, you use Form 8606 to report the amount of the distribution and to calculate the taxable portion of the distribution. If you do not have a cost basis in your IRA because all of your contributions to the IRA were fully deducted on your prior year returns, then your entire distribution from your traditional IRA is treated as taxable and you do not complete Form 8606. So here are the situations where Form 8606 is required. You made non-deductible contributions to a traditional IRA for 2015, including a repayment of a qualified reservist distribution, or you received distributions from a traditional SEP or simple IRA in 2015, and your basis in traditional IRAs is not more than zero. For this purpose, the distribution does not include a rollover, qualified charitable distribution, one-time distribution to fund an HSA, conversion, recharacterization, or return of certain contributions. You converted an amount from a traditional SEP or simple IRA to a Roth IRA during the year. Or you received distributions from a Roth IRA in 2015 other than a rollover, recharacterization, or return of contribution. Let's talk now about rollovers to Roth IRAs, also known as Roth conversions. You can convert amounts from either a traditional SEP or simple IRA to a Roth IRA, and these conversions are treated as a rollover regardless of the conversion method used. You may also roll over eligible distributions from qualified retirement plans to a Roth IRA. For tax years after 2007, you are also allowed to roll over to a Roth IRA all or part of an eligible distribution that you received from you or your deceased spouse's qualified pension, profit sharing or stock bonus plan, 401k plan, annuity plan, tax sheltered annuity plan under Section 403B, and deferred compensation plans of a state or local government. The rollover is subject to the same rules that apply for converting a traditional IRA to a Roth IRA. Now, a rollover into a Roth IRA is not tax-free. You must report the rollover distribution on Form 1040. If the rollover was from an IRA, enter the rollover distribution amount on Form 1040 on line 15A, which is this line right here. If you have a tax basis in your IRA, complete Form 8606 to figure the taxable portion of the rollover, and then enter the taxable portion on line 15B. If the rollover was from an annuity plan or a pension plan, you will enter the total distribution in box 16A, then enter the taxable portion of that rollover distribution into box 16B. Generally, in the case of pension plans or retirement plans, the entire rollover will be taxable unless you can show that you have a tax basis in that plan. Now let's talk about tax on early distributions. That's when you take money out of an IRA or a retirement account before you reach the minimum retirement age. The tax on early distributions is commonly referred to as the early withdrawal penalty. You won't see that terminology appearing anywhere within IRS publications and instructions, but it's kind of the layman's language used by tax professionals like us. You will generally be required to pay an additional 10% tax on your early withdrawal from your qualified retirement plan, IRA, or annuity if you withdraw funds before you reach the age of 59 and a half. The tax applies to the taxable part of the distribution. There is a 25% additional tax on early distributions if you take them from a simple IRA during the first 2 years of participation in that plan. Your Form 1099-R should show code S in box 7 if you are required to pay this additional tax. And there is a 5% additional tax on certain early distributions from deferred annuity contracts. So let's talk next about how to report an early distribution from an IRA, pension, or annuity. You report a taxable distribution from your IRA on Form 1040, line 15B, so you said right here, and you report a taxable distribution from an annuity or a pension plan on line 16B. Now, if you were under age 59 and a half at the time of the distribution, you will be required to pay a 10% tax unless you qualify for one of the exceptions that's discussed next. If you do not qualify for one of the exceptions to the penalty, enter the penalty amount on Form 1040, line 59. And that is this line right here, line 59, additional tax on IRAs, other qualified retirement plans, etc. Attach Form 5329 if required. So let's talk about some of the exceptions to the early distribution. You're going to need to pay an early distribution penalty, normally 10%, if you withdraw money from your pension plan or IRA before you reach the age of 59 and a half. But there are exceptions to that penalty, and that's what we're going to talk about now. And these penalties that I'm going to discuss first apply to both IRAs and pension plans. There are a number of different situations in which the tax for an early distribution does not apply. Situations that qualify as exceptions to the additional tax include payments made as part of a series of substantially equal periodic payments made at least once per year for your life or life expectancy or the joint lives or life expectancies of you and your beneficiary. If the qualified plan is not an IRA, you must have separated from servicing your employer. So essentially this first exception applies because you have retired from working for your employer and you have a pension plan with them and you've started to take equal periodic distributions from the plan as if you are retired, because you are. And then that is permitted and you wouldn't be subject to the penalty even if you're under age 59 and a half. Also, payments made because you are totally or permanently disabled, or totally and permanently disabled. Payments made to a beneficiary on or after the death of the plan participant or contract holder. Payments made from a qualified retirement plan other than an IRA after your separation from service in or after the year you reach age 55. However, that age is reduced to 50 for qualified public safety officers or employees. Payments made under a qualified retirement plan other than an IRA to an alternate payee under a qualified domestic relations order. This is essentially referring to a divorce situation where the divorce decree or the court decree is saying that you have to distribute money from your retirement plan and give it to your spouse as part of this divorce. And if that's the reason why you've done the distribution, you're not subject to the penalty. Payments made from a qualified retirement plan to the extent that you have medical expenses in excess of 10% of your adjusted gross income, or 7.5% if you or your spouse is age 65 or older. Payments made from an employee stock ownership plan for dividends on employer securities held by that plan. Payments made from a qualified retirement plan due to an IRS levy of the plan, and qualified distributions to reservists while serving on active duty for at least 180 days. Now, there are some additional exceptions to the additional 10% tax, but they apply to IRAs only. What's interesting about these exceptions is they are some of the better exceptions. If I'm interviewing a client and it seems that they're going to be subjected to a penalty, but I'm looking for a way to help them get out, odds are they're going to get out because of one of these exceptions. However, the bad part to these exceptions is that they apply to only IRAs, and if my client took the money from a regular pension plan and not from an IRA, they're basically up the creek without a paddle. But let's take a look at these. The additional tax does not apply to distributions from IRAs to the extent that you paid for medical insurance premiums while you were unemployed, or to the extent of your higher education expenses that you paid through cash or loans for yourself, your spouse, your children, or grandchildren. Or up to $10,000 can be withdrawn penalty-free for first-time home purchase for yourself, your spouse, your children, your grandchildren, or your ancestors, provided the home purchase occurs within 120 days of the distribution. So how do you claim an exception to the early distribution tax? Well, if you qualify for one of the exceptions listed above, you must complete Form 5329 Part 1 to claim the exception. You do not need to complete the form if you do not qualify for an exception to the penalty. So in other words, if you don't qualify for an exception to the penalty, you'll go ahead and you'll enter the early distribution amount, the taxable part of that early distribution, on line 15 or 16, depending on what type of plan it comes from, and then you will simply go down to line 59 and smack the penalty on the line. No Form 5329 is required if you don't qualify for an exception to the penalty. Let's talk briefly about annuity income next. If you made contributions to a tax-deferred annuity plan, you will have a tax basis in the plan. And most taxpayers use the simplified method to figure the taxable part of distributions received from an annuity. Under the simplified method, you figure the tax-free part of each monthly annuity payment by dividing your cost in the plan by the total number of expected monthly payments. If you received more than one annuity and at least one of them is not fully taxable, then enter the total amount received from all annuities on line 16A of Form 1040 or line 12A of Form 1040A. And we actually spent quite a bit of time talking about the simplified method and completing worksheet illustrations in our course on pension and Social Security income, but no space for it here today. Next, we're going to talk about the taxability of Social Security. And of course, Social Security income on the long Form 1040 is reported on line 20A and 20B. Taxable Social Security benefits include monthly survivor and disability benefits, but do not confuse Social Security with Supplemental Security Income or SSI payments, because SSI is not taxable. Figure the taxable part of your Social Security benefits by completing the Social Security Benefit Worksheet number 1. Up to 85% of your Social Security or Railroad Retirement Tier 1 benefits may be taxable. To find out whether any of your benefits are taxable, compare the base amount for your filing status with the total of 1/2 of your benefits plus all of your other income, including tax-exempt interest. When making this comparison, do not exclude from your income interest from qualified U.S. savings bonds, employer-provided adoption benefits, foreign earned income or foreign housing exclusion, or income earned in American Samoa or Puerto Rico by bona fide residents. Your base amount that we referred to up here, which is take half your Social Security benefits, add it to all of your other income, and then compare that to your base amount. Well, the base amount depends on your filing status. $25,000 if you are a single head of household or qualifying widow. $25,000 if you are married filing separately and did not live with your spouse at any time during the year. $32,000 if you are filing a joint return, or $0 if you are filing separately but you did live with your spouse during the year. So let's talk about the worksheet methodology, and then I'm going to actually show you an illustration of the worksheet. Social Security Benefit Worksheet number 1 walks you through a series of calculations to help you determine the portion of your benefits that are taxable. These calculations work in 2 stages as follows. Stage 1, add up all taxable income shown on lines 7 through 21 of Form 1040. Then add in any tax-exempt interest you received, but do not include Social Security benefits that you received. Subtract the total from the total of your adjustments to income. Then subtract the total of your adjustments to income. Add back any amounts excluded from income on Form 8815, U.S. Savings Bond Interest Income, or Form 2555, the Foreign Earned Income Exclusion, or Form 8839 for Qualified Employer-Provided Adoption Expenses, or Form 4563, Income of Bona Fide Residents of American Samoa. So you can see the add-backs are not too common. Then you also add in 1/2 of the Social Security benefits. The number you calculate at this point is called your modified adjusted gross income. Compare your modified adjusted gross income with the base amount for your filing status. And the base amount, again, is $25,000 for single or head of household and $32,000 for joint filers. And for most married filing separate filers, it would be 0. If your modified adjusted gross income is less than your base amount, then none of your benefits are taxable. But if it is greater than your base amount, then some of your benefits are taxable. The next step is to determine if the amount by which your modified adjusted gross income exceeds your base amount exceeds the next two threshold amounts, $9,000 for single head of household or $12,000 for married filing joint. You will multiply the difference between the amount by which your income exceeds your base amount and the figures you've seen here by 50%. The number that you will arrive at is the taxable portion of your benefits. Stage 2 of the worksheet takes you through some additional steps, because if your modified adjusted gross income exceeds your base amount by more than $9,000 if you were single or $12,000 if you were joint, then more than 50% of your benefits will become taxable. You will multiply the amount by which your modified adjusted gross income exceeds 85% and then add that amount to 50% of $9,000 if you are single or 50% of $12,000 if you are married filing joint. You'll use the lesser of this amount, or 85% of your total benefits, to arrive at the amount of benefits that are taxable. So let's look at an illustration of how this methodology is working. Jordan, a single filer, had $30,000 of pension income and $10,000 of Social Security income for the year. Figure the taxable portion of the benefits as follows. Take his pension of $30,000 and add in 1/2 of his Social Security benefits. That gives you his modified adjusted gross income of $35,000. Now, the base amount for a single person is $25,000, so we're going to enter that as a negative amount. Subtract that from the modified adjusted gross income, and you're left with $10,000. Where does $10,000 sit with respect to the next level for a person who is single? Remember this number right here that we're mentioning, enter $9,000 for single filers and $12,000 for joint filers. Well, $10,000 compared to $9,000 is $1,000 more. Quite simple. The difference is $1,000. So we're going to multiply that difference by 85%, and when we do that, we get $850. The next step is to take that $9,000, divide it by 2. When we do that, we get $4,500. We then add $850 to $4,500, and we get $5,350. The next step is to determine where that comes out, as opposed to taking the total Social Security benefits he had for the year and multiplying that by the max limit of 85%. When you do that, you get $8,500. So Jordan's taxable benefits are going to be the lesser of 85% of $10,000, or $5,350. And in this case, $5,350 is the lesser amount. Now, we can do all of these computations on the worksheet, and the worksheet is intended to remind you of all of the rules and make sure you compute all of the steps. So the first step on the worksheet is to enter the Social Security benefits that he received for the year, $10,000. We then enter half that amount, or $5,000. We enter all of his other income for the year, $30,000. We add those numbers together and we get $35,000. The worksheet then says, look to the base amount for your filing status. If you were single, that's $25,000. So we subtract $25,000 from $35,000 and we're left with $10,000. Then it says enter $9,000 if you are single. So we do that. Line 11 says 9. We subtract line 11 from line 10 and that gives us $1,000. Now the instructions say multiply 1,000 by 85%. When we do that, we get $850, and we enter that on line 16. We also take that $9,000 number and multiply that by 50%. We get $4,500. And then the instruction says multiply line 1 all the way back up here by 85%. We do that. The total is $850, and we enter $850 on line 16. We now take $850, we add that to $4,500, and that gives us $5,300, and then we take the lesser of $5,300, or $8,500. $5,300 is the lesser number, and so $5,300 for the case of Jordan is the amount that we would enter on line 20B. So if I take this particular 1040 form here, the way it would work for Jordan is I would enter $10,000 on line 20A. So for Jordan, what I would do is I would enter $10,000 on line 20A, and I would enter $5,350 on line 20B. And that concludes our brief look at Social Security and pension income. Let's move on now to self-employment income. So you will need to file Schedule C, or in some cases, if you qualify as Schedule CEZ, to report income and expenses from self-employment if either of the following is true. Number 1, your net earnings from self-employment are $400 or more, or you have received a 1099 miscellaneous reporting income of $400 or more in Box 3, Other Income, Box 5, Fishing Boat Proceeds, or Box 7, Non-Employee Compensation. We look here, and I've got a copy of Schedule C for you, and we're going to be taking a look at many of the different features on this form in terms of how we figure expenses and a little bit about income. But a real description in detail of how to complete this entire form, you're going to need to refer to our course on sole proprietors and single-member LLCs. We spend 6 hours really getting into in depth on self-employment income. But for today, it's going to be kind of a whirlwind tour through the deductibility items, particularly under expenses and some of the rules for home office. You can see on page 2 of the form we have cost of goods sold, information on the vehicle, and finally Part 5 where we enter other expenses. So let's start at the beginning of Schedule C by talking about gross receipts or sales. And I think this is actually a good time to load up a copy of IRS's form Schedule C. So let me grab that. So I've got Schedule C up on the screen in front of you now, and we are going to move right down here to Part 1 where we look at gross receipts or sales. And you must report on your tax return all income that you receive from your business unless it is excluded by law. And in most cases, your business income will be in the form of cash, checks, and credit card charges. Business income, though, can also come from other forms such as property or services that you receive in exchange for your services or property. And these other types of income that you might be receiving are described in Publication 334. You'll see here on line 4 of the form, it provides space to enter something called cost of goods sold. You have cost of goods sold if you sell a product that you manufactured or purchased from others. You calculate cost of goods sold by subtracting your closing inventory for the year from your opening inventory plus purchases made during the year. And actually, cost of goods sold, there is a section for that, Part 3 of Schedule C. And you begin by entering your opening inventory for the year. You enter your purchases and other costs that you might have in the creation or acquisition of that inventory. You then subtract out the closing inventory that you still have on hand at the end of the year, and when you're done with that computation, you have cost of goods sold. And now we're going to move on to talk about expenses claimed on Schedule C, and we're going to spend most of this part of today's class on expenses. Deductible expenses must be ordinary and necessary in carrying on a trade or business, and certain expenses attributable to the production or acquisition of property for resale cannot be deducted currently. These must be included in inventory or they must be capitalized. Some of the more common business expenses include the following. Advertising. This can include the cost of yellow page, radio or television ads, direct mail, and other promotional costs of your business. Quite frankly, these days it often includes internet. The internet advertising budget of many businesses is, I think, the largest amount that they now spend. Car and truck expenses. You can see here this is line 9. You can deduct the actual expense of operating your car or truck or take the standard mileage rate. This is true even if you used your vehicle for hire, such as a taxi cab. Auto expense reporting requirements must be followed. If you claim any car or truck expenses, you must provide information by completing one of the following. Either Part 4 of Schedule C or Part 5 of Form 4562, and 4562 is the form used to figure depreciation and amortization. You use Part 4 of Schedule C only if you used your car for business and you are not otherwise required to file Form 4562. You can use Part 4 of Schedule C if you are claiming the standard mileage rate, you leased your vehicle, or the vehicle is fully depreciated and you are not required to file Form 4562 depreciation and amortization for any other reason. If you used more than one vehicle during the year, attach your own schedule with the information requested on Schedule C, Part 4 for the additional vehicles. There are certain situations where Form 4562 is required. You must use Form 4562 and complete Part 5 for listed property, including Section B, information on your use of vehicle, if you are required to file Form 4562 for any other reason, and you must provide information about the business use of your auto. Do not make an entry on line 9 of Schedule C without also entering amounts in Part 5 of Form 4562 or Part 4 of Schedule C. Local transportation expenses. Local transportation expenses are not travel expenses. However, certain local transportation costs are deductible. Local transportation costs include the ordinary and necessary costs of all of the following: getting from one workplace to another in the course of your business or profession when you are traveling within your tax home, visiting clients or customers, going to a business meeting away from your regular workplace, getting from your home to a temporary workplace when you have one or more regular places of work. These temporary workplaces can be either within the area of your tax home or outside that area. Temporary work location lasting 1 year or less. If you are assigned to a temporary work location in the area of your tax home, you may be able to deduct transportation expenses subject to the following. If you have a regular job location and you commute to a temporary work location in the same trade or business, you can deduct the expenses of the daily round trip between your home and that temporary location. If you have no regular place of work, but ordinarily work in the metropolitan area where you live, you can deduct daily transportation costs between a home, your home, and a temporary work location, but only if that location is outside of your metropolitan area. Commute costs are the cost of driving to and from work within your metropolitan area. Commute costs are never deductible. The following transportation is considered to be commute: driving to a temporary job site when you do not have a regular work location. If you don't have a regular work location, you cannot deduct daily transportation costs between your home and a temporary work site that is within your metropolitan area. These are called non-deductible commuting expenses. But if you are driving from your home to a second job, you also cannot deduct the cost of driving from your home to a second job. That is also non-deductible commute. But if you have two places of work, then you may be somewhere where you can claim a deduction. And the following rules apply if you work at two or more places in the same day. You can deduct the expenses of getting from one workplace to another, but if for personal reasons you cannot go directly from one work location to the next, such as a detour to visit your doctor on the way to your second job, then you can only claim expenses equivalent to what it would have cost you to travel directly from one work location to the next. So IRS in Publication 17 on page 183 provides this particular diagram, which does a good job of helping to clarify when an expense for travel in your car is considered to be commute and when it is transportation expense. Firstly, you can see that we have travel from home to your regular work job. That is never deductible. And home to your second job, never deductible. But if you have home and you travel to a temporary work location, it is deductible so long as you have another regular work location that you normally work at. Also, if you travel from your second job to a temporary location or from a regular job to a temporary location, that is always deductible. And if you travel from your second job to your regular job or back again, that is always deductible as well. So let's look at this summary table of some of the deductible local transportation costs and compare those to costs that are considered to be non-deductible. You are allowed to deduct the cost of commuting from one job to another in the same day, and fees for parking while attending a meeting away from your normal work location. You can also claim the cost of putting an ad on your car, and you can claim the cost of operating a for-profit carpool which you operate as a business, and you can claim added costs that you pay because you haul tools or instruments to work. However, non-deductible costs include the cost of commuting to and from your job, never deductible, and that includes parking. Fees for parking while you are at work, not deductible. Advertising displays on your car do not create a business use for the vehicle itself, which must still be tracked separately. And you cannot claim the cost of your share of carpool expenses that you pay to travel to and from your job. And the fact that you haul tools or instruments to and from work does not mean that you are using your car for business. And IRS has specifically stated that union member trips to a union hall are not deductible. Let's talk about parking now. And we're still on this car and truck expense line. Fees you pay to park your car at your place of business are non-deductible commuting expenses. You can deduct the cost of business-related parking expenses only when you visit a customer or client or attend a meeting away from your normal work location. Allowable auto expenses, if you are allowed to deduct them, you can claim the actual cost of operating the vehicle, or you may be able to claim a standard mileage allowance. But whichever method you use, you must keep adequate records to prove your business use. Let's talk about the standard mileage allowance now. You must use actual expenses if you used 5 or more vehicles simultaneously in your business, such as in fleet operations. you cannot use actual expenses for a leased vehicle if you previously used the standard mileage rate for that vehicle. But you can take the standard mileage rate for 2015 only if you owned the vehicle and used the standard mileage rate for the first year that you placed that vehicle in service, or you leased the vehicle and are using the standard mileage rate for the entire lease period. For 2015, the standard mileage rate is 57.5 cents for each business mile driven. That's up from 56 cents per mile for 2014. Now, there is some additional information you should be aware of when you decide to choose the standard mileage rate. This information comes from IRS Publication 463. You can find it on page 16. If you want to use the standard mileage rate for your car you own, you must choose to use it in the first year that your car is available for use in your business. Then in later years, you can choose to use either the standard mileage rate or actual expenses. You must make the choice to use the standard mileage rate by the due date, including extensions of your return. You cannot revoke the choice. However, in later years, you can switch from the standard mileage rate to actual expense. If you change to the actual expense method in a later year, but before your car is fully depreciated, you will have to estimate the remaining useful life of the car and then use straight-line depreciation. For example, standard mileage rate was not claimed in the first year. What's going to happen? Larry is an employee who occasionally uses his car for business purposes. He purchased the car in 2013, but he did not claim any unreimbursed employee expenses on his 2013 return. Because Larry did not use the standard mileage rate the first year that the car was available for business use, he cannot use the standard mileage rate in 2015 to claim unreimbursed employee business expenses. For leased autos, if you want to use the standard mileage rate for a car you leased, you must use it for the entire lease period. And here are some important standard mileage rate rules that you should be aware of. Number 1, you can claim the standard mileage rate instead of depreciation, gas, insurance, lease payments, licenses, oil changes and other maintenance costs, registration fees, repairs, and tires. Also, you must choose the standard mileage rate for the first year you use your car for business. And if you claimed actual expenses for a car that you leased rather than own, you cannot claim the standard mileage allowance in a later year. If you claimed a standard mileage allowance on a car that you leased rather than own, you cannot claim actual expenses in a later year for that same car. But this rule does not apply if you actually own the car. If you choose the standard mileage rate, you cannot claim actual costs for operating your car in the same year. And even if you claim the standard mileage rate, you can still claim allowable costs for parking and tolls, because these are not part of the standard mileage rate. You cannot claim the standard rate if any of the following is true. You operate 5 or more cars at the same time in your business. You claimed a depreciation deduction other than straight-line depreciation for the car in an earlier year. You claimed a Section 179 deduction for the car in an earlier year. You claimed a special depreciation allowance on the car, or you are a rural mail carrier who received a qualified reimbursement, or you claimed actual expenses on a leased car. When claiming standard mileage, you will multiply the number of business miles driven by the standard mileage rate. Let's take a look now at actual car expenses. You have a choice between the standard mileage rate and actual car. If you choose to claim actual expenses, your allowable expenses will include depreciation, car rent and parking fees, or garage rent and parking fees, gas, oil, and maintenance, insurance, lease payments, license and registration fees, repairs and replacement tires, and tolls. Even if you claim actual expenses, you must still track the number of business miles you drive so that you can prorate your costs between business and personal use. And here is an example. You drove your car 15,000 miles during 2015, and 10,000 of these miles were personal, 5,000 were business. Your actual cost for operating the vehicle was $7,000 for the year. Figure your allowable deduction as follows. 5,000 divided by 15,000 is 33% business use. You multiply 33% by $7,000 and you're left with $2,333 as being the allowable actual cost deduction. Business versus personal use. If you use your car for business and for personal use, you must maintain adequate records to show your business use. The acceptable methods of tracking business use include keeping up a mileage log. The log should record the date you drove, the place traveled to, and the miles drove. Also, the reason for your travel. Or you can use your personal calendar of appointments to log miles driven for your appointments. My summation when I've worked with IRS auditors on the issue of mileage logs is they really don't care what kind of a log you keep as long as you have one and that the log is showing the day-to-day use of the vehicle. You may use actual expenses or the standard mileage rate in any year so long as you use the standard mileage allowance in the first year your car is available for use in your business. However, if you switch to actual expenses in a year following a year that you claim the standard mileage rate, you must use straight-line depreciation when figuring your actual expenses. And this rule is described in IRS Publication 463 on page 17. Let's talk now about interest on car loans, because most people do buy cars with a loan and therefore are paying interest on these loans. Whether you can claim a deduction for interest you paid on your car loan depends on if you are self-employed or an employee. Employees can never deduct the cost of interest as an employee business expense because interest on car loans is treated as personal interest. Personal interest is not deductible, and you can read more about that on page 16 of 463 as well. If you are self-employed, though, you are allowed to claim the cost of interest on your car loan as a business expense on Schedule C. You will multiply the amount of interest paid by the business use percentage of the vehicle to arrive at your car loan interest deduction amount. Figuring allowable car expenses. If you use your car for business, you can claim the actual cost of operating the car or claim the standard mileage allowance, but whichever method you use, you must keep actual adequate records to prove your business use. I also wanted to remind you that there is a depreciation component to the standard mileage rate. If you claim the standard mileage rate, the depreciation portion of each business mile driven varies by year. The depreciation component of the standard mileage rate per year is as follows. For 2015, it is 24 cents for each mile driven. For 2015, the standard mileage rate is 57.5 cents per mile, and part of that is for the operational cost of the vehicle. The other part is the depreciation component. 24% of that 57.5 cents per mile is depreciation, and these are the depreciation components of the standard mileage rate for all of the earlier years you see listed. Okay, so that concludes our coverage of auto expenses. We're now going to move on to line 10 of Schedule C, where we look at commissions and fees paid to other businesses. These are deductible. Typically, you're going to need to issue a 1099 when you claim a deduction on that line if you paid an individual over $600 during the year. Also, contract labor on line 11. Here you can deduct expenses paid for services performed by non-employees, and again, you should be issuing a 1099 miscellaneous. We cover all the rules for 1099 miscellaneouses in the full version of this course. Depreciation and Section 179 expense deduction. We're moving on now to line 13. If you placed property in service or had listed property in service during the year, you must attach Form 4562, Depreciation and Amortization. Otherwise, you must maintain an accurate depreciation schedule for your business, which shows how you calculated your depreciation deduction. Depreciation and amortization deductions are covered in Pacific Northwest Tax School's course called Depreciation Made Easy. Employee benefits programs, line 14. You may deduct the cost of accident and health plans, group term life insurance, and dependent care assistance programs that you paid for your employees. Do not claim any expenses that you paid for yourself, though. You may claim expenses you paid for your spouse or other members of your family, but only if they were employees to whom you issued a W-2. You should note that health insurance premiums paid by a self-employed person may be deducted as an above-the-line deduction on Form 1040. And so we've got a line for that right here, line 28, the self-employed, line 29, self-employed health insurance deduction. So if you are self-employed and you paid health insurance for yourself or members of your family, you will claim that deductible amount, if you qualify to claim it, on line 29 of the Form 1040. But you would never on Schedule C on the insurance line, or line 14, the employee benefit line, claim an amount that you paid for your own health insurance coverage. Now, the deduction for self-employed health insurance coverage is limited to your net profit from Schedule C, minus any deductions you claim for the deductible part of SE tax or self-employment tax, plus contributions to the sole proprietor's benefit for a simple or qualified plan. Next in line, we have insurance other than health insurance, and this is where you would enter liability, hazard, workers' compensation insurance, things like that. Then we have a line for interest. That's line 16. You can deduct interest amounts that you paid for loans that you took out for business use, but you must have been liable for the debt, and you must have actually paid the debt. Legal and professional fees, line 17. Deduct fees charged by accountants and attorneys that are ordinary and necessary expenses directly related to operating your business. Include fees for tax advice related to your business and for preparation of tax forms related to your business. Also include expenses incurred in resolving asserted tax deficiencies related to your business. And if you have an entry on line 16 or line 17 rather for legal and professional expenses, it could be that you are also required to issue a 1099 miscellaneous. Office expenses include office supplies and postage, line 18. And pension and profit sharing plans are the next line, line 19. You can deduct contributions that you made to a pension, profit sharing, or annuity plan or benefit plan for your employees. But if you made a contribution to your own retirement plan, you do not enter it on Schedule C. Instead, you would go over to the long form 1040 and claim that amount as a deduction on line 28, self-employed, SEP, simple, and qualified plans. And we talk about how to compute deductions and allowable contributions to self-employed pension plans in our course on above-the-line deductions. We have a course called Above-the-Line Deductions, and since it is an above-the-line deduction, that's where we cover that particular tax aspect in greater detail. Moving on to line 20, rent or lease. You may deduct expenses you paid to rent buildings or other properties for use in your business. Line 21, repairs and maintenance. You may deduct the cost of labor and supplies used to maintain or repair business property, but do not include any of the following expenses in this category. Repairs to office use of home, improvements to property that changes or extends the useful life of the property, or the value of your own labor. We then have supplies, which are claimed on line 22 of Schedule C. Supplies are items that you consume or use up, and examples of supplies include small tools with a useful life of 1 year or less used by a furnace installation business, or shampoo, conditioner, and perming solution used in a beauty salon. In most cases, you can deduct the cost of materials and supplies only to the extent that you actually consumed them and used them in your business during the year, unless you deduct them in the prior year. However, if you had incidental materials and supplies on hand for which you kept no inventories or records of use, you can deduct the cost of those that you actually purchased during the tax year, provided that the method clearly reflects your income. You can also deduct the cost of books, professional instruments, equipment, etc. if you normally use them within a year. However, if their usefulness extends substantially beyond a year, then you generally must recover their cost through depreciation. Also on the supply line, this is where you would claim the cost of providing meals if you are operating a child daycare or an adult foster home care business. If you provide meals to your employees or to customers or patients in the normal course of your business, you should claim this expense as a supply expense or cost of goods sold expense, and not as a meal or entertainment expense that is subject to the 50% limit. Let's talk a little bit about family daycare providers, because they have actually got an additional special rule that applies to them. And I just wanted to point this out, that this is family daycare providers only. It does not include adult foster care homes. For tax years beginning in 2003 and later years, instead of using actual costs, family daycare providers can use the standard meal and snack rate to compute the deductible cost of meals and snacks provided to eligible children. The standard meal and snack rate can be used for a maximum of 1 breakfast, 1 lunch, 1 dinner, and 3 snacks per eligible child per day. You should note, though, that a family daycare provider who receives a reimbursement for a particular snack or meal can deduct only the portion of the applicable standard meal or snack rate that exceeds the amount of the reimbursement they received. Family daycare provider. A family daycare provider is a person who is engaged in the business of providing family daycare. So what's family daycare? Well, family daycare is child care provided to eligible children in the home of the family daycare provider that meets all of the following requirements. The child care is non-medical. The transfer or a transfer of legal custody is not involved. The child care generally lasts for less than 24 hours each day. Eligible children. Eligible children are minor children receiving family daycare in the home of the family daycare provider. Eligible children do not include children who are full-time or part-time residents in the home where the child care is provided, or children whose parents or guardians are resident of the same home. And here's an example where children of a provider are not eligible. A family daycare provider's own children, and any children who live in the family daycare provider's home on a full or part-time basis, are not eligible children, even if they receive daycare services from the family daycare provider. So if you are a family daycare provider, you can choose between claiming the actual cost of the meals that you provide to the children, or you can use a standard meal and snack rate. And the U.S. Department of Agriculture updates this table each year on July 1st. You can see here we have the location of the family daycare provider, and if you are in any of the contiguous states, the contiguous 50 states, then the amount that you are allowed to deduct for each child is $1.28 for breakfast, $2.40 for lunch, $2.40 for dinner, and 71 cents for each snack. The amounts for Alaska and Hawaii are higher. A family daycare provider who chooses to use the standard meal and snack rate for a particular tax year must use the rates for all deductible food costs for eligible children for that year. And you can learn more about this particular provision by reading IRS Publication 587 on business use of your home. Next in line, we have taxes and licenses, line 23 of Schedule C. You can deduct the following taxes and licenses. State and local taxes imposed on you as a seller of goods or services. If you collected this tax from the buyer, then you must also include the amount collected in gross receipts or sales. You can also enter as a deduction real estate and personal property taxes that were paid on assets of the business, licenses and regulatory fees, Social Security and Medicare taxes that were paid to match required withholding from your employee's wages, but you will need to reduce any deduction you claim by the amount shown on Form 8846, line 4, which is the form used to claim the credit for employer Social Security and Medicare taxes paid on certain employee tips. You can also deduct federal unemployment tax that you paid, federal highway use tax, and contributions to state unemployment insurance funds. But taxes you are not allowed to deduct on Schedule C include federal income tax, including self-employment tax, estate and gift taxes, taxes assessed to pay for improvements such as paving and sewers, taxes you paid on your home or your own personal use property, state and local taxes on property purchased for use in your business, because these are not actual taxes that are deductible as tax. Instead, you will add them to your basis or cost in the asset and claim a depreciation deduction. State and local taxes imposed on the buyer that you are required to collect and pay over to the state or local government. These taxes are not included in gross receipts or sales, and they are not deductible expenses. The next line we're coming to on Schedule C is travel expense. And you can see it says travel, meals, and entertainment, and then it is subdivided into two categories. One is travel, and the other is deductible meals and entertainment. Let's talk about travel. Expenses you incur when traveling for business are deductible subject to certain rules. To claim travel expenses, you must have a regular place of abode in a real and substantial sense, and you will have a regular place of abode if all of the following is true. You work in the same vicinity as your claimed abode, and you use it while you're doing business. Your living expenses incurred at your claimed abode are duplicated when you're away on business, and you have not abandoned the vicinity in which your place of lodging and claimed abode are both located, or you have a family member or members, marital or lineal, currently residing at your claimed abode, or you use the claimed abode frequently. Tax home, you need to have a tax home, and so that you can show you are traveling away from your tax home on business. And your tax home is your regular place of business or post of duty, regardless of where you maintain your family home. It includes the entire city or general area where your main place of business or work is located. You can claim the cost of expenses you incur while traveling away from your tax home overnight. But if you do not have a regular place of business or post of duty, and there is no place where you regularly live, you are considered to be a transient, and your tax home is wherever you happen to work. As a transient, you can never be away from your tax home, so your travel expenses are never deductible. So let's talk about having a main place of business or work. If you have more than one place of work, consider the following when determining which one is the main place of business or work. The total time you ordinarily spend in each place, the level of your business activity in each place, and whether your income from each place is significant or insignificant. Traveling away from home. You are traveling away from home if your duties require you to be away from the general area of your tax home substantially longer than an ordinary day's work, and you need sleep or rest to meet the demands of your work while you are away from home. This rest requirement is not satisfied, though, merely by napping in your car. Also, you do not have to be away from your tax home for a whole day or from dawn until dusk, so long as your relief from duty is long enough to get the necessary sleep or rest. IRS Publication 463 provides two illustrations where you have qualifying and then non-qualifying travel. And in the first one, we have qualifying travel. You are a railroad conductor and you leave your home terminal on a regularly scheduled round trip run between two cities and then return home 16 hours later. During the run, you have 6 hours off at your turnaround point where you eat 2 meals and rent a hotel room to get necessary sleep before starting the round trip. You are considered to be away from home in this situation, and the travel expenses would be deductible. But in the second example, we have non-deductible expenses. You are a truck driver. You leave your terminal and return to it later the same day. You get an hour off at your turnaround point to eat. Because you are not off to get necessary sleep and the brief time is not an adequate rest period, you are not traveling away from home. In addition to the rules on travel, one of the rules on travel is that you must be working at a temporary assignment or job. You're not traveling if your assignment is permanent, is what I mean. And so in order for travel to be incurred, you have to show that you're traveling for business purposes and that you are away from home on a temporary basis. So let's talk about what it is to have a temporary assignment or job. If you are temporarily assigned to a job at a location away from your tax home, you can deduct your temporary living expenses as travel expenses subject to the following. Your assignment must be considered temporary in order for you to claim the expense. A temporary assignment is one that you realistically expect will last 1 year or less and does in fact last 1 year or less. And if your assignment is indefinite, that is expected to last more than a year, the location of your assignment then becomes your new tax home and the cost is not deductible. So how do you determine this definite or temporary, or indefinite or temporary? How do you tell? To determine if your travel is temporary or indefinite, you should apply the following rules. If you are indefinitely assigned to a work location, then that work location becomes your tax home. You must determine if your assignment is indefinite or temporary when you start your work. You may claim temporary living expenses while you are away from home up until the day you first become aware that your assignment has become indefinite or will last more than a year. Members of the armed forces who are on permanent duty assignment overseas are not traveling away from home. And naval personnel assigned to ships with eating and sleeping facilities are considered to have a tax home aboard ship for travel purposes. If you are on a probationary assignment with the understanding that you will keep your job upon satisfactory completion of the probationary period, then your assignment is considered indefinite for travel purposes. Going home on your days off. If you travel home on days off to visit your family, you can claim travel expenses equivalent to what meals and lodging would cost you had you stayed in your temporary home. This rule applies, though, only if you are assigned to a temporary work location away from your tax home. And if your temporary assignment is expected to last more than a year, you cannot claim the cost of expenses you pay for your temporary home or meals. You should note, though, that if your assignment away from your family home is indefinite or is expected to last more than a year, you cannot deduct any costs associated with traveling to your family home on your days off. However, if your travel away from your tax home to the vicinity of your family home is for business reasons, then you can deduct the cost of the business travel to the vicinity of your tax home, and you should see tax home different than family home in IRS Publication 17 for more information on that. Qualifying travel expenses. Okay, we've established that you are traveling for business purposes and that your travel expenses will be deductible. Now let's look at what kind of qualifying expenses you might be able to deduct. IRS rules consider travel expenses to be the ordinary and necessary expenses of traveling away from home for your business, profession, or job. The primary reason for the trip must be business. So let's look at whether the primary reason for the trip is business. If your trip is primarily for business, you can deduct all of the necessary travel expenses, but you may not be able to deduct costs associated with personal side trips or to lengthen your stay for personal reasons. And here is an illustration where the trip is primarily for business. You travel to Hawaii for a convention. The convention lasts 3 days, but you stay a week to enjoy a short vacation. You may deduct the cost of traveling to and from Hawaii and the costs associated with meals and lodging surrounding the convention. The costs for meals and lodging that you incur on your additional vacation time are not deductible. Let's look at if the trip is primarily for personal reasons. If your trip is primarily for personal reasons, you are not allowed to deduct any of your travel expenses, but if you incur direct business expenses while you are on your trip, you can deduct those expenses. And here's an illustration where the trip is primarily personal. You travel to Hawaii for a week's vacation, and while in Hawaii, you attend a one-day seminar related to your business. You cannot deduct any of the costs associated with travel to or from Hawaii. You cannot deduct the cost of lodging or meals in Hawaii, but you can deduct the cost of attending that seminar. Cost of bringing friends or family members with you. Sorry, the cost of bringing friends or family members with you is not deductible, and here's an illustration where your spouse travels with you. You travel to Hawaii to attend a 4-day seminar, and your spouse decides to travel with you. Because of a package deal you were able to purchase, the cost of staying in Hawaii for 7 days is the cost of staying for 4. You can deduct all costs of travel, meal, and lodging for yourself, but you cannot deduct any of the costs associated with your spouse traveling with you, and this is true even if your spouse assists you in performing your job duties. Conventions. You can deduct your travel expenses when you attend a convention subject to the following rules. The convention agenda or program shows the purpose of the convention. The agenda is related to your position in such a way that it shows your attendance was for business purposes. You can show that your attendance benefits your trade or business. You cannot deduct the travel expenses of bringing your family with you, and if the convention is for investment, political, social, or other purposes unrelated to your trade or business, then it is fully non-deductible. Meal expenses. So we're on to line 24B, deductible meals and entertainment. Unless you meet the rules for business entertainment, you cannot deduct the cost of meals unless it is necessary for you to stop for sleep or rest to properly perform your duties. For your allowable meal expense, you can use the actual cost of meals, or if you are traveling away from home, you can claim the actual cost of meals or the standard meal allowance. The standard meal allowance covers the cost of your daily meals as well as incidental expenses that you incur while traveling away from home on business. Incidental expenses include costs for fees and tips given to porters, baggage carriers, bellhops, hotel maids, stewards, and stewardesses. I think they call them flight attendants these days. Transportation between places of lodging or business and places where meals are taken if suitable meals can be obtained at a temporary duty site, and mailing costs associated with filing travel vouchers and payment of employer-sponsored charge card billings. But incidental expenses do not include amounts that you paid for laundry, cleaning, and pressing of clothing, lodging taxes, or the cost of telegrams or telephone calls. Let's talk now about daily per diem rates. The standard meal allowance is based on the daily per diem rate, and daily per diem rates vary according to the city and the country you are traveling to. Rates are published by the U.S. government and are updated at least annually. Travel within the United States is usually what we're looking at, and travel within the continental United States is called CONUS. The per diem rates are revised each year for CONUS on October 1, and for the last 3 months of the year, taxpayers can use either the per diem rates effective October 1 of the preceding year or the revised rates effective October 1 of the current year. You must use either the current rate or the revised rate consistently for all travel during that period. For 2015, the standard rate for most areas of the country is $46 per day, but it could be a higher amount per day if you are in one of the high-cost areas. And if you would like to look up rates for the various high-cost areas, you can click on this URL here for government per diem rates, and it takes you to this site. You then just select the state, city, or the zip code that you are in, and that allows you to determine what the per diem rate for your area is. Now, I've extracted a few of the more common cities, or some sample cities, let's say that. I've taken some sample cities, looked up the per diem rates for you, and inserted them into this table just to give you an idea of how those higher rates can be calculated. For Los Angeles, Seattle, Las Vegas, Chicago, or Washington, D.C., the daily per diem rate is $71 a day. For Portland, Oregon, Philadelphia, and San Diego, it's $66 per day, and Milwaukee, Wisconsin, and Salt Lake City are both $61 a day cities. Per diem rates for travel outside of the continental United States, well, the standard meal allowance rates for CONUS do not apply for travel in Alaska, Hawaii, or any other location outside the continental United States. The Department of Defense establishes per diem rates for Hawaii, Alaska, Puerto Rico, American Samoa, Guam, Midway, and the Northern Mariana Islands, as well as the U.S. Virgin Islands, Wake Island, and other non-foreign areas outside of the continental United States. And you can access per diem rates for these non-foreign areas at this URL that takes you to the Defense Travel website. 50% limit on meal and entertainment expenses. Whether you claim the actual cost of your meals and entertainment expenses or the daily meal per diem rate, you may only claim 50% of your allowable expenses. But if you are a transportation worker, you can deduct up to 80% of your business-related meal expenses if you incur the expenses while subject to the Department of Transportation's hours of service limits. These limits generally affect the following categories of workers: airline pilots and flight attendants, train conductors, and interstate truckers. In addition to being allowed to claim 80% meal expenses, workers who are subject to the hours of service limits are allowed to use higher daily rates than the $46 a day allowance allowed for non-transportation workers. The higher rates are as follows. If you are inside the continental United States, it is $59 a day, and if you are outside the continental United States, it is $65 a day. Separating travel and meal expenses, meal and entertainment expenses should be listed separately and never lumped together with other business expenses. And here's an example. Travel and meals should not be lumped together as a single expense because allowable travel other than meals and entertainment is not subject to the 50% limit. Entertainment expenses. So entertainment is something that is considered to be different than meal expense, but some meals are considered to be entertainment. You can deduct ordinary and necessary entertainment expenses provided they are directly related to business or they are associated with business. Directly related to business, to meet the directly related test, all of the following must be true. You expect to derive income or some other specific business benefit other than goodwill at some future time, but it is not necessary to demonstrate that you actually received the benefit. You actively engage in a business meeting, discussion, or other bona fide business transaction with the person being entertained, and the principal purpose of your combined business entertainment activity is the active conduct of your trade or business. It is not necessary to devote more time to business than to the entertainment to meet this requirement. Entertainment associated with business. If your activity does not meet the directly related test, you may still be able to deduct it if you can show that it satisfies two conditions. Firstly, the activity does have a clear business purpose, and the entertainment itself directly precedes or follows a substantial, bona fide business discussion, generally within a 24-hour period. However, circumstances can allow for otherwise. Utilities. Next line on the form, line 25. The cost of gas, electricity, trash, water, heating oil, and telephone for a business use property can be entered on this line. However, you can also list telephones separately. The old-fashioned telephone lines that connect to a home are essentially gone. The old businesses still have them, but telephones are just different than they used to be. However, do not include the cost of your main home phone line if you work from your home. Also, do not include any of the utility costs for office use of home. The next line we're looking at is wages. You may deduct salaries and wages that you pay to employees for the year. Do not include salaries and wages deducted elsewhere on your return or amounts paid to you. Reduce your deduction by any wage credits that you claimed. For employees, your employees may include your spouse and children or any other person whom you hire to work for you in your business. If you provided compensation to your employees during the year, you are subject to additional reporting requirements, which are also discussed in the longer version of this particular section of the course, which is our course called Sole Proprietors and Single Member LLCs. And finally, we've gotten to other expenses, line 27. But there's not enough space to list all of these expenses, and so we actually move down to Part 5 of Schedule C, where you can enter all of the other expenses you might have. You should list the type and amount for each expense separately in the space provided. Do not include the cost of business equipment or furniture, replacements or permanent improvements to your property, or personal living and family expenses. Also, do not include charitable contributions. You may not deduct fines or penalties paid to a government for violating any law on this line. If you are claiming a deduction for amortization, you must complete and attach Form 4562. Let's look at some of the types of business expenses that could be entered as another expense. And the first in line is business gift expenses. And remember, there is a $25 limit on those expenses. You can deduct up to $25 per year per client for the cost of gifts you give in the course of your trade or business. Gifts you give to family members of a customer are considered to be gifts given to that customer. Work-related education expenses. To be deductible, your educational expense must be required by your employer to keep your present salary, status, or job, serve a bona fide business purpose, or maintain or improve skills needed in your present line of work. Even if these tests are met, you cannot claim a deduction for your education costs if they are needed to meet the minimum educational requirements for your present trade or business, or they are part of a program of study that can qualify you for a new profession. Also, no double benefit allowed. You may qualify to claim certain higher education expenses as an adjustment to income on Form 1040 or as an education credit. If you qualify to claim educational expenses in more than one way, you should choose the method which benefits you the most. You may not, however, use the same expenses as a business expense on Schedule C and then claim them again as an adjustment to income or as an educational credit. What kind of educational expenses are you allowed to deduct? Well, you can claim deductions for the following: tuition, books, supplies, lab fees, and similar items, certain transportation and travel costs, and other educational expenses such as research costs, typing costs, etc. Under transportation, you may claim the cost of traveling to and from school as follows. If you are going to school on a temporary basis, that is 1 year or less, you can deduct the cost of traveling from work to school and then from school till home. But if you're going to school for more than 1 year, you can deduct only the cost of going directly from work to school. Password number 3 is dwarf. D-W-A-R-F. Dwarf. And now we're going to move on to business use of home. So let's just pop back up here and take a look at this section of the form. It says, line 30, expenses for business use of your home. At no time should you ever enter any part of the cost of doing business from your home under the expenses category. Instead, you would figure your deduction and enter it on line 30. And in most cases, you're going to be completing Form 8829. However, there is a new simplified procedure where you are allowed to figure your deduction for home office and enter it on line 30 without completing Form 8829. So let's talk a little bit about business use of home now. Generally, you can deduct expenses or business expenses that apply to a part of your home, but only if that part is exclusively used on a regular basis. As your principal place of business for any of your trades or businesses, as a place of business used by patients, clients, or customers to meet or deal with you in the normal course of your trade or business, or in connection with your trade or business if it is a separate structure that is not attached to your home. Now, there are 2 exceptions to this exclusive use rule: if you use areas of your home for inventory storage or if you are operating a daycare business. Under the inventory storage, you use this space on a regular basis to store inventory or product samples, and your home is the only fixed location of your trade or business. So what does principal place of business mean? Well, your home will qualify as a principal place of business for deducting expenses for its use if you meet the following requirements. You use it exclusively and regularly for administrative or management activities of your trade or business, and examples include billing customers, clients, or patients, keeping books and records, ordering supplies, setting up appointments, forwarding orders, or writing reports. And you have no other fixed location where you conduct substantial administrative or management activities of your trade or business. If you are going to be claiming home office expenses, in most cases you would need to complete Form 8829 to figure your business use of home deduction. But there is a simplified option for claiming the home office deduction. Beginning in tax year 2013, taxpayers may use a simplified option when figuring the deduction for business use of home. The simplified option does not change the criteria for who can claim a home office deduction. It merely simplifies the calculation and record-keeping requirements of the allowable deduction. Highlights of the simplified option are that a standard deduction of $5 per square foot of the home used for business with a maximum of 300 square feet is allowed. Home-related itemized deductions are still claimed in full on Schedule A. For example, mortgage interest and real estate taxes are not prorated between the home office deduction and are instead claimed in full on Schedule A. Also, depreciation for the deductions for the home are not claimed, and for years that the simplified home office deduction is claimed, there would be no later recapture of depreciation when the home is sold. And no carryover of the unused part of the deduction is allowed. So if you have a carryover of home office expenses because you're not allowed to deduct them because your profit from your business is not large enough to allow a full deduction, you are allowed to carry that unused home office deduction forward on Form 8829. But if you are using the simplified method, the deduction is lost. You cannot carry it forward. So let's look at this table here. It does a comparison of the two methods for claiming home office expense. First, we have the simplified option, and then there is the regular method where you use Form 8829. Under the simplified option, the deduction for home office use of a portion of a residence is allowed only if that portion is exclusively used on a regular basis for business purposes, and that rule is the same under the regular method. Under the simplified option, allowable square footage of the home used for business cannot exceed 300 square feet, but under the regular method, it would be the actual percentage of the home used for business, regardless of how large. A standard amount of $5 per square foot is used to determine the home business deduction under the simplified option. Under the regular method, you will use actual expenses, and you will use records that you have maintained to determine what those are. Under the simplified option, home-related itemized deductions are claimed in full on Schedule A, but under the regular method, home-related itemized deductions must be apportioned or prorated between Schedule A and the business schedule, either C or F. Under the simplified option, no depreciation is allowed, and under the regular method, depreciation deductions for the portion of the home used for business are allowed. Under the simplified option, there is no recapture of depreciation on sale of the home, and under the regular method, you do have to recapture depreciation on the gain upon sale of the home. Under the simplified option, the deduction cannot exceed gross income from business use of the home, less business expenses. Under the regular method, the rule is the same. Under the simplified option, the amount in excess of gross income limitation cannot be carried forward, but under the regular method, you are allowed to carry it forward. And under the simplified option, the loss carryover from use of regular method in prior year cannot be claimed. So if you had a loss on your 2014 return, so that you were not able to use all of your 2014 home office deduction, you are allowed to carry the excess forward to 2015. But if in 2015 you decide to use the simplified option, you would not be allowed to use that deduction. And under the regular method, you would be. So let's finish up this part of today's class by a brief talk about record keeping. Record keeping is one of the most difficult things for small business owners to do. They just can't seem to find the time or recognize or grasp the importance of record keeping, and so it's our job as practitioners to really cover this topic with our clients when we're working with them on their tax returns. You are required to keep records which prove your business income and expenses. Adequate record keeping can be accomplished in the following ways. If you are claiming business expenses, you will need to keep receipts. It is wise to charge your gas and other business expenses to a different credit card than you use for personal expenses. That way, it is easier to track and separate business expenses from personal expenses. You should keep an envelope in your car. This is not a requirement, but it's a good idea, where you can store your receipts as you acquire them. And then as soon as possible, take that envelope in the car, file your receipts in an organized manner, because remember that lost receipts equal lost deductions. You should maintain your business records for a minimum of 3 years from the date you file your return, and a canceled check is not considered to be adequate evidence of an expense. It should be accompanied by a receipt or other documentation. So that completes part 3 of today's class. It's time to go back to the LMS and do a few review questions, see how well you've grasped the topics covered in part 3, just to rehearse and get ready for the final exam at the end of today's class. And when you are finished doing those review questions, resume video playback and come back and we'll get on with part 4 of today's course.